As you know, inclusion is a very important topic today, and most countries and governments are about the goal of empowerment. One of the ways of economic empowerment is insurance. And one of the ways to get insurance to remote parts of countries is microinsurance. Today we have with us a leading personality on microinsurance, Professor David Dror. We'll spend the next few minutes trying to understand from him what microinsurance is, how his particular model of microinsurance has been implemented, and what are the plans for scaling microinsurance through other parts of India as well as around the world. So, Professor Dror, there's a lot of buzz about microinsurance everywhere we go. Donors are talking about it, the private sector is talking about it, the regulator is talking about it. Can you start briefly by telling us what microinsurance is?
Smaini, thanks for this interesting conversation. If anything, I think there isn't enough buzz. We are at the beginning of a buzz because microinsurance is a game changer in very many domains, in social security, in financial protection, in insurance literacy, in financial literacy, and in very many other related domains where the effect of targeted programs until now has been minimal and there is still a huge scope to grow. What's microinsurance? My definition of microinsurance is that it is insurance, which means there is a premium and there is a quantified, defined risk, which is termed in the language of benefits that people may expect to be paid by the underwriter when a set of circumstances occurs. If those circumstances do not occur, there will not be payment and there is no return of the premium. This is the basic insurance principle of transfer of risk against a cost. The unique feature of microinsurance, what makes insurance micro, is that the definition of the risk relates to the conditions which are at the lowest level of society. The lowest level of society is a community. Below a community, it's a family, a household, an extended family, or a village. So the unit for discussion of microinsurance is the community. And the nature, the features, the rules in use by communities compensate to make microinsurance possible at that level, where commercial transactions would, in all probability, be impossible to introduce at that level because people do not necessarily trust outsiders. People feel that there is a huge parity in the power of the players. A commercial insurer, even a small one, is viewed as much more powerful than a single insured. And there is also the trust issue. When people have to pay up front, where the tangible return would only be callable if a certain event happened, the person who got the money may not be there anymore, and one needs to go search them, and one needs to convince them to pay. And if they do not pay, many people feel this is a huge risk. So they don't necessarily trust. Within the community, however, the rules in use are such that people are much more engaged in trustworthy relationships. And this is where microinsurance, therefore, needs to unfold.
Thank you, Professor Dror, for that helpful definition of microinsurance. You used the word trust. Do you mean to say that people trust microinsurance more than commercial insurance?
People either trust or they don't trust. They trust interlocutors who will be there to actually deliver the contract. Insurance is a different kind of a contract than other exchanges where goods and payment exchange at the same time. It's not that you can say that people trust everyone else better than commercial insurer, but we have plenty of evidence, and it is very well known, that people within villages, within communities, have a different relationship with interlocutors, with partners, with neighbors, with family, than they do with outsiders. If that outsider, in addition, is more powerful and may use that power to their advantage, that doesn't help trust. This is why in most countries, insurance business is regulated very severely to ensure, through the government, through the regulatory office, that the fiduciary responsibility can be kept and that the contract can be enforced by the weaker party when the time comes. We don't have that in microinsurance. There is no guarantee by a regulatory authority that this kind of microinsurance would unfold as smoothly as it should. And when the claims are low, when the benefits one can get is low, it means that the cost of transacting enforcement needs to be extremely low, next to zero. This can happen in the village. It does not happen with commercial relations. Commercial relations always end up arbitrating differences of opinion or conflicts of interests in a formal way. And a formal way is expensive and time-consuming. In the village, in the community, these things are done in an informal and much faster way. So the issue is not only the trust, the issue is what are the mechanisms to resolve conflicts of interest which might be there in a manner that is acceptable and that is completely in line with the rules in use that people know and are completely conversant with.
Professor Dror, you are saying then that because the community runs the microinsurance scheme, it is more trusted by members of the community?
That's what I'm saying. That's what the empirical evidence corroborates time and again. We should not, of course, fall into stereotypes. Not everything in the village is rosy and cozy. There are all kinds of situations in which people may not live up to their word, and there are such issues at every interaction and in every transaction. However, what is unique to the community from the commercial relationship is that in the commercial relationship there is essentially a contract between a company and an individual, whereas in the community there is a contract between all the community and all the community. If one person does not live up to his or her engagements, the reality of the community is that the members of the family of that person will have to live up, because it's the reputation of the entire family, and the reputation cannot be lost. The risk of being branded as unreliable or dishonest could go as far as excommunication. Nobody can afford that risk. Therefore, communities are in fact underwritten by the notion that families back their own kin and kith, even if they are out of line. This does not exist in commercial relationship at all. So we are actually mobilizing here the kind of rules in use that have been in existence, that have evolved and have been in existence and have kept communities alive, not because of rules of the state, but in spite of rules of the state, even when they were not sufficiently effective in implementing rules of society. And they work very well. And every child in every place, in every village, knows from day one the structure of the community. And those rules, they may not be written, but amongst the illiterates, that's not a disadvantage. Everybody knows the mode of proper behavior. What does a responsible adult do? I can willingly defy you and say that most people who have an insurance contract still don't know what are the rules of insurance. So here is your framing of the situation. This is why community is so powerful and so useful for the base of the pyramid, which counts hundreds of millions. So to say, let's first of all reshape the informal sector into formal and then introduce insurance. This is not going to happen in my lifetime. I need solutions for my lifetime. Everybody needs solutions for their lifetime. So we need to be banking on what works, what people understand, what people know, what people are willing to expand and extend into new forms, including insurance.
Professor Dror, you mentioned the informal sector and bottom of the pyramid. And we know that insurance is not a pull, typically. How do you create demand at the bottom of the pyramid?
Creating demand is an interesting and important issue. The theory about creating demand, certainly for health insurance, has evolved from the thoughts after the Second World War of Friedman and Savage and the expected utility theory. The basic issue has always been that people act out their individual quest for utility, and utility is translated into wealth, gains of wealth. While we have issues relating to diminishing value of added utility, there nevertheless is the basic thought that people act their own personal interest, which is measured in wealth. I doubt that this set of theories, which have been further developed by Pauli, by Niemann, by several others, I doubt that these theories actually reflect accurately the situation in the informal sector. Because of this interdependence of communities, there is strong evidence to uphold the thought that in fact what matters, what creates demand, is what is good for our community, not just for me. Individuals cannot afford to maximize their own utility to the detriment of significant others. And because this dynamic is so important, what people really are motivated by is what's going to be creating welfare gains to the entire community. Where am I willing to make a compromise? Because that compromise creates more gains for all of us. And what is good for all of us is ultimately also good for me, because it may reduce my responsibilities towards those others. So I measure issues not just in terms of my wealth and the diminishing utility of that wealth, but the welfare gains to the group. If we assume that theory of demand to govern the relationship, we also have to assume that policies would not be individual. Policies would need to be for a group. And those group policies are not simply aggregations of many individuals who happen to be haphazardly in the group, but there would have to be some kind of a value for each and every member in the group. For instance, value to a group might mean that many people can claim a benefit even if that benefit is small, rather than a few claiming huge benefits on rare occasions. So hospitalization may compete with outpatient care. Outpatient, many more incidents, frequencies much higher, severity much lower. This is a totally different profile of insurance than hospitalizations, which will only happen once or twice in a lifetime and may cost a huge amount of money. Low frequency, high severity. They're less interesting, at least initially, before the market becomes mature. The other element is, if you only tap few individuals who consider that they might gain a lot from insurance, but you don't tap all the others, there is no benefit to creating a market. To create a market where market does not exist, you essentially need to change the notion of what does every responsible adult do. If it becomes the typical mode of behavior that everybody accepts and everybody understands, then you've got the basis with which to create a market. And the Western solution has been to think of expected utility theory, but then mandate insurance. So insurance became something you sell, not something that is bought. And how do you sell it? Because there is a legal obligation to be insured. Then it's easy. You don't need to worry about demand. You just worry about selling, outselling some other seller. The competition between sellers, and the competition is usually not so much on price as on reputation, on proximity, on some kind of intangibles. Here, the market works otherwise. If you're not sensitive to the demand, to creating the demand, which is based on community-based welfare gains, there is no way to push anybody. There is no way to sell it to anyone. And then you might as well forget about microinsurance. Microinsurance is, by definition, in its DNA, a demand-driven, needs-based, and therefore context-relevant kind of insurance that has to create gains not for single individuals alone, to the detriment of all the others, but for the whole community, to which everybody contributes.